Hello and welcome to the No Flipping Excuses Show, the only podcast in real estate investing that teaches what you need to know to find and flip deals right now. Wow. Break free the chains that are holding you back and join us on this episode with Jason Lucchesi.
Hey, what's up? It's Jason Lucchesi and welcome to the No Flipping Excuses Show. I have one of my good friends joining me today, my former Wharton brethren. And no, we didn't actually go to Wharton. We just love Wharton so much. We wear Wharton socks. We wear Wharton underwear. We just go Wharton all out. But I've got my good friend Sal Buschemi with me. And Sal and I have been working together for, wow, I think it's almost been 10 years. 10 years.
10 years.
Jeez.
10 big ones, booby. 10 big ones.
So for those of you that don't know Sal, he is the commercial investor. He is the known guy that knows practically everything there is about commercial. And he's going to talk about some really good things. We were talking offline here just a little bit ago. And when you think about commercial, a lot of people think multifamily, and Sal is going to talk about some other strategies in commercial that people aren't utilizing and he's taking advantage of. So Sal, for people that don't know you and your background, why don't we start there and then move into commercial stuff?
Well, Jason, like most people who are speakers in this space, I was really poor. And then one night I took a pill and woke up the next morning rich. And that pill was real estate.
Nice. I want one of those.
Right? No, my background started actually in the late 90s working at Goldman Sachs. I've learned this business from the best and brightest bankers in the world, world-class investment bankers. And at the age of 29, I went on to raise $30 million during the crisis. I think you were working at Countrywide at the time.
I was.
During the subprime crisis. And we raised $30 million from a large hedge fund in New York, and I was only 29, and we became the kitchen sink for Bear Stearns. We were buying all of their rough product, not even REOs. These are loans that people have forgotten to foreclose on in very affluent areas all over the country, and even very impoverished areas such as, Gary, Indiana, speaking to an Indiana native there.
Yeah.
But we were seeing how, like, a lot of people were being fleeced because they were overpaying for a lot of these junker homes, if you will, thinking that they were making an effort towards building their retirement. I learned a lot from that. And in 2010, we bought a special servicing company for $1, and that focused on the real estate hard money lending and commercial. And there were a lot of people who lost a lot of money, and we recapitalized that with $15 million. And we were buying assets out of receivership, bankruptcy, fraud, litigation for literally pennies on the dollar using a Dutch auction technique. I'm not really going to get into that too much, but we made a lot of money doing it. And the best way to communicate what a Dutch auction is that basically no one else is going to make any more off of you than you will on your deals. And so we were offering people literally like 10 cents on the dollar. And that was pretty cool. But the problem is a lot of it went back to like farmland and lizard and snake territory, which nobody really wanted. Right now, we're doing a lot of independent sponsor deals. I haven't raised a fund yet for this. My third fund, I'm looking into doing it. However, I don't really know where the market is right now. And there's two schools of thought on it. Number one, which is what I tend to believe, is that rising rates are going to hurt smaller balance commercial owners. So all those people who thought it was cool, those doctors and dentists between $3 and $30 million asset sizes, multifamily, self-storage, who are buying things like Class C for a 5 cap in Savannah, they're going to be in a world of hurt because they're not going to be able to unload that. And that's going to be sort of, I think, the pressure going across. There are already explosions going off and, these smaller assets all over the country. But you're going to see that a lot of times the banks are going to want to call the loans due, even though they're performing, but because borrowers have blown through their loan covenants. And especially with multifamily, the first way you can see this, the death spiral usually starts with, people who are, just like in residential, people who are out of state, plastic surgeons from Southern California rushing in to buy an apartment complex in El Paso. Nobody's making any money, so they fire the management company, and that only exacerbates the problem. So you're going to see all sorts of fun stuff happen. And, rates are going, the economy is about as good as it can get right now. Thanks to President Trump, whether you like him or not, people are feeling very wealthy. However, interest rates have to rise to stave off a lot of inflation, and that's usually not good for real estate, especially residential real estate and commercial real estate, which is valued only off of the income. Jason Lucchesi, thank you. If I didn't say it, it's a pleasure and a privilege to be on your podcast today. Thank you very much. I feel like Rush Limbaugh here. Cigar. Let me tell you something.
Well, thank you, sir. Thank you, sir.
You're welcome.
Yeah, no, I agree with you. Fed rate hike just went up. Was it last week? And no, I agree. Since Trump has taken over, the economy has been booming, whether you like him or not. We're not going to get into a political thing here because I know, there's going to be some folks upset. Yeah, we don't have time for that.
Yeah.
But no, I agree with you. So Sal, you've got this experience, and I know we know each other for a long time. Lots of experience. You've raised funds. You've raised tens of millions of dollars, hundreds. Okay, hundreds of millions of dollars. Wharton. So why are you saying no? Like I'm still a big fan. I like multifamily and self-storage, but I understand there's other opportunities out there that aren't being utilized. Let's talk about that. What do you see right now as other assets that aren't being utilized in commercial?
I think I do like multifamily, but if you have to get into the right basis, you have to get into a good discount. And a lot of people went in there and they bought thinking that, well, I'm buying at a 5 cap. But they're looking at it from the standpoint of just an emotional attachment to a piece of property they bought because they want to feel better at night knowing they did something and they're involved in a deal. However, that usually comes with 20, 40, 200 tenants, most of which are kids who you didn't have any, benefit of making on your own. And yeah, AJ was the poster child of this. He owned a lot of stuff. He's my COO, but he owned a lot of stuff in Iowa that he was managing over here. He bought it at the right basis, so now he's selling. Actually, he's a net seller because this is about as good as it gets for commercial real estate or real estate in general. You want to start selling your assets now if you want to. But I think as far as what we're looking at other things are our office space and Class A office space in large cities. We're also looking at some development deals too as well, industrial here in Las Vegas. But what we do is we don't do the deals ourselves. We merely invest our capital into very qualified operators, and that's what we do. We call ourselves LPs. And so what we do is we take our own capital and capital that we raise from other people, and we co-invest alongside. Usually they're called family offices, and these are people who are real estate families that own a lot of commercial real estate. They developed it. They've been through cycles. They're not someone fresh out of a seminar. And so we feel very well building our portfolio that way, buying something. I've seen too many people buy an emotion because, their near-to-well brother-in-law who's a Lyft driver at night now all of a sudden wants to get into real estate. And you know how that happens. He wants to buy a multifamily. So he's begging from his friends and family just so he can get off his brother's couch. To become a real estate entrepreneur. Buying a commercial building is not the end. Buying an apartment building is not the end all be all of everything. And you got to remember, you're dealing with tenants there who are basically a huge credit risk. And I want people to write that down. It's a huge credit risk because you don't know if these guys or girls are going to have jobs the next day or not. Right. Whereas if you own, say, one of the deals we're looking at is in Coral Gables, is a Class A office complex. Do you think Prudential is going to be around for 15 years to pay the rent? Probably, So what would you feel better at night? And I got into this heated discussion once at an event in Tampa, and one guy was making 12% on his rentals, and he was saying, I'm getting a 12% cap rate. I said, well, first of all, that's single-family residential. There's no such thing as a cap rate in single-family residential. Nobody's going to buy it off of a cap rate. They're going to buy it off of comps. All right, Booby? Second, I said, the reason why you're making that is because you're taking on more risk. I'd rather make an 8 with a rent escalation every year or 2 years of like 1.5% until the day I die than having to deal with collecting rent from some guy in Gary, Indiana, who you don't know if he's going to have a job tomorrow. If he can't qualify for a loan today and he hasn't been able to qualify for a loan ever, then something's really wrong with him because anybody with a pulse can get a loan today to buy a home. And that's the way it's been. That's the way that this country's been engineered. Both the Obama and the Trump administrations are focusing more on home ownership. So they want to make sure that there's loans readily available for everyone. If you don't have a loan, if you can't get a loan to buy a home, something's wrong. And so you got to look at the quality of the tenants. I mean, how do you want to retire? This is paying for my mom to stay in an assisted living facility at $9,000 a month. Okay, do you think I'm going to put her care in the hands of some flaky tenant in a bunch of row homes somewhere in Baltimore or Gary, Indiana, or
Right.
a bunch of single family rent? Oh, I can't pay the rent because I'm chasing down my tenant. He owes me, the $150 a month that I'm going to be making off of the cash flow. If I do not believe in renting out single family residential. I believe if you're going to build a portfolio, the best way to do it is to pool in your money with other people or learn how to raise money and learn the business so that you can participate. That's the best way of commercial real estate, is that you can participate many different ways.
Are you talking about when you're talking about pooling, are you talking about doing something through like a private placement memorandum? Or...
Yeah, that kind of stuff. Yeah.
Okay.
Yeah, that's exactly what I'm talking about. Yeah.
And I know
but you have to talk. You see, this is the other problem too, Jason, is that all these people feel as though they go to some lawyer. I'm not mentioning names, but there's some people out there and they'll say, don't you dare talk to an investor without having paid $20,000 for a private placement memorandum, subscription agreement, operating agreement, and management agreement. Fine, but that's like buying a dress to the prom if you don't have a date to the prom. If you don't have any investors, you got wet for nothing. And legal information scares people, right? It's a great way to sell people. Lawyers sell by scaring people into doing things. I can tell you the SEC is not going to come knocking down your door because you showed them a pitch book of a potential deal or something that you like. The moment you start taking money, yes, then you have to have, you have to be buttoned down. But to merely talk to someone, you should have a pitch book first to talk to them. The only thing you should be doing in commercial before doing anything is just talking to investors, seeing what they like first, and then you find the deals and you back into it later. If your spouse was just allergic to shellfish, you wouldn't take him or her to an oyster bar, would you? And that's the same thing. They're going to be people who are like, they like multifamily. They have this belief system because they're watching, Joanna, Gaines on TV, thinking that, residential is the only way to go. So that's their belief system.
Right.
I think it's kind of an ignorant belief system, but I also believe that the money always has a voice. And if you follow what they want first, then you're going to be much more successful and you're going to be much faster getting towards success too, because you will follow a structure.
No, I hear you. And, for folks that obviously they don't know what a PPM is, it might be something that might go over your head right now, but you may have to go through a less route where it's structuring private money in a way to where you're not putting it into a structure such as a PPM. So Sal, let me ask you this. What is a good way, for somebody starting out for raising some capital? And I know there's ways to do it through non-accredited and accredited investors. And we'll touch on what those terms mean here in just a second. Yeah. But for folks that are just starting out, and I know you work with folks that are just getting started with commercial as well, what's some good ways to get started with finding actual legit money lenders?
Here's what I think. You don't want to look at it as lenders. You just want to talk to them as investors, okay? Yep. Because the investors are going to talk to you and they say, well, using you, Jason, you're the professional. You know better what to do with this money than I do. So when you're talking to, I would say just get comfortable talking to investors, people in your spheres of influence, the country club, church, the Kiwanis Club, whatever it is. Whatever club it is, that's important. I also like talking to investors who are investing in other things. LinkedIn is great for that. You can find what other people are doing. One of my tricks is around tax season. What I do is I usually send out a letter that drives people to a website. And what I do is I pay for the ship. I find this is a very interesting hack here. This is two things that you're going to like.
Nice.
Number one, find accountants that do Form K1 taxes. These are partnership returns. These are people who have already invested in real estate, so they're receiving some sort of a partnership. So if you find the accountants who do that, that's perfect. You want to stay away from the H&R Block and Pistol Pete, the tax return preparer. You just want to deal with the guys who deal with the rich people and do the special taxes for them. All right. And ask them, look, I'll pay for your postage if I can put a mailing in there, because everybody opens everything that comes from their accountant. It's some sort of a statement. It's still a very old dinosaur industry where a lot of people don't use, real-time computers, for example,
right,
or interwebs. So that's the best way to get in contact with them. The other thing too, which I think is something that's worked very well for us in our venture capital raises here, has been this. Start talking to people about what it is you do, and they're going to say, okay, Jason, what do I do next? And what I do is I say, look, you're going to want to start pouring some of this money into a self-directed IRA, meaning taking it from a traditional IRA or a Roth IRA into a self-directed traditional or self-directed Roth IRA. There's companies out there. We like using VantageIRAs.com. I don't own them, but that they seem to move very, very quickly, and they move very, very quickly when it comes time to do stuff. There are other people I don't like. You can guess if they're close to Jason geographically. I don't like them, so we'll leave it at that. They're slow, and we've moved over.
I agree.
But there's a lot of them there, and a lot of people are going to say, well, Fidelity has a self-directed IRA. No, that's not true. That's just a marketing pitch that they're trying to borrow from. Because when you're dealing with the big brokerage houses, all they're going to do is sell you a sushi menu of high-fee mutual funds, maybe some ETFs and some other stuff. But here's the trick. Once you get that money into a self-directed IRA, it's never going back. It's never going back to where it came from, Booby. And the reason is because people just don't have the time or effort to do this. And I would actually go as far as to shepherd people and send them printouts and these little sign here tabs. You know what I'm talking about?
Oh, yeah.
Like when you're filling out a mortgage or a paperwork or a contract on real estate, saying, here, fill this out and everything. I would print it out, put the stickers on it. And then I would, offer like a concierge to them. And then you can send it out by priority mail to them, and it gives you an excuse to follow up with them. Then they know that you're serious about this. Yep. And then it's like, wow, this guy spent time and resources. So Jason really is serious about this. This is how he makes a living off of this. He's not just an Uber driver at night. And that's the whole point of it. No, it happened. I've seen it happen. It's like you see people's LinkedIn profiles, like real estate investor and Uber driver. So, but the key is that once that money moves over into a self-directed IRA, it ain't never going back because people are just lazy.
Yeah,
it is. And then they're going to be calling you and say, all right, Jason, I got the money. What do? I have $100,000 sitting in the account. Where's the deal? You promised me there's a deal. Now that's a high-class problem to have because now you've all of a sudden become someone who started their own private bank. Does that make sense?
Oh, yeah, for sure.
So that's what I would be doing if I was starting out. Just raise capital first. Get some training. We can talk about that later. But the point is you should also have a pitch book. And if your listeners want it, I can give them a URL for the pitch book that they can download. But it's free, done for you, meant for commercial. It's meant for multifamily, self-storage, and office and stuff. But it really makes sure that you're wearing the right clothes to the party and that you're not worried about grammar or sounding like an idiot. We'll talk about that later.
And I've had the chance to see some of your pitch books before. So, yeah, at the end here, we'll put that URL out. It's a great.
If I want to, we'll see. We'll see.
we'll check on that. No, that was a great Wharton hack that you just gave away about the tax stuff.
Yeah, but do it. People did. I mean, you're talking to someone all day. Just talk to it. I mean, we had an apprentice come in with his wife, who's a bartender, and she's raised $1 million just by having people use that one hack. Wow. And now her husband's like getting banging over the head with phone calls saying, I moved all this money. Where's the deal? Where's the deal? Where's the deal? There you go.
Wow.
That's how you do it. Yeah.
Wow.
Pretty good stuff. Pretty good. Slick stuff, isn't it?
That is. You only get taught that kind of stuff by going to Wharton.
Yeah. And everybody thought it was all going to be about like potty jokes on this, right? With you and I? No, not at all. Not at all.
So what so you said what was this the second part to that? That was you said there was two parts.
Yeah, the first part is to mail your stuff is one way. So it's not a part. It's one way is to mail a letter out with a link to your pitch book to people who are receiving statements from the accountant. I would go to an accountant who's experienced in doing K1 partnership filings. And I haven't had my coffee yet. I'm naturally the spastic, but they do Form K1s. They send it out to their investors. You put in a flyer saying, hey, we do all these great real estate deals. Why don't you take a look at what we have to offer with a link to your website? That's number one. The number two thing is that once you get them in there, what you want to do is you want to start talking to them about, hey, are you going to be using savings or tax advantaged? And tax advantage is IRA, 401k. Everybody today somewhere has a 401k from their 20s that's just laying around somewhere that they haven't touched from an old job that probably has about 15 $75,000 in it. They don't know what to do with it. So that's how you sort of grease the chute. The easier you make it for your investors, the easier it is going to be for you to get the gold from them.
No, I like that. And I liked how you said you put like those little sticker things, just like where you're supposed to sign when you're at the title company on there, to make it like ridiculously simple for them. And that's really what it's all about. It's making it simple.
You don't say this to your investors, but you just assume that they're just stupid. All right. and no, I mean, I work with plastic surgeons. The guy is like, I mean, he's ADD. He's all over the place. He makes a lot of money. He does like 6 breast augmentations a day. I mean, he makes a lot of money, but he also has, 4 kids. And, he's like, what do I'm like, do this, fill out the form. He's like, just make it easy for me. I'm not a finance guy like you. I'm like, okay. So you make it easy, write in a 3rd grade language, the emails you send to them. Don't send it to someone like you're sending it to Carl Icahn. Okay. Nobody cares about how smart you are. Make it very easy for them to understand what to do. Even if you have to draw out a diagram, do that. And we've done that.
I would definitely assume so. That would be something that would have to be done. So
here's a checklist. Sign here, initial here, sign here. Once that's done, here's the self-addressed envelope and send it to Vantage or the other IRAs that you like.
Yeah, no, I'm gonna have to look into Vantage. I haven't heard of that one, so I'll have to connect with them because
I know the CEO. He's a good guy. They're based in Phoenix.
Oh, cool.
And I don't own them. I don't have any stake in them, but they just helped us a lot with our sophisticated investors.
Nice.
Very quickly.
No, that is good. That is good. So when we're talking about properties, I know you talked about more office space type buildings. Is that kind of where you and some of your partners and apprentices are going more towards? Is more towards that?
People, yeah. I didn't mean to interrupt, but people today, that's where the deals are. Well, everybody zigs, the smart money zags, and our investors are wealthy people, and what they want is long-term cash flow. This is like an avatar, if you will, of our investors. They're 50 and above. They are on their 2nd marriage. They have a later model wife. They have 2 kids from their prior marriage. They drive certified pre-owned Lexuses and BMWs, and they have less than $2 million in assets. Liquid assets, but they are scared to death that they're going to outlive their savings or they will expire and nobody will be able to take care of their kids and second wife.
Gotcha.
So that's what gravitates towards them. 2 million is a magic number because anyone who's a registered investment advisor listening to this understands that really nobody makes money by managing anyone with $2 million. It's like you're rich, but not rich enough. You know what I mean? It's sort of like the GED, the good enough diploma, right? It's sort of like, what Chris Rock would say. It's a good enough IRA, but it's not that good. So that's fine. With interest rates are still low, how are you going to retire on that? And so people like the advantage of leveraging their money, not signing on the debt, by co-investing with smarter people who have been around, who are well capitalized, who have a lot of their own skin in the game into these deals. And that's what we do at Dandridge Partners. And we've used that model not just for real estate, but also recently, as you saw with our letter to LPs in venture capital. Actually, one of our latest deals, Warren Buffett is actually making an investment in. So that's pretty cool. So that's it's your network, so your net worth. And I totally, obviously I network with you. People network with Jason. So your networks are directly proportionate to your net worth. But I would never have found these deals if it wasn't for the New York circles that I come from.
Oh yeah, for sure. Frankly. For sure. So
and being able to speak the same language. But yeah, these are the hacks we use, and we use them every day. So if it's good for us, it's good for you.
Absolutely. So what would you say as far as networking? You've obviously done quite a lot of that over your years. How important is that to you? Because I know you mentioned LinkedIn, and we have a whole entire training program on LinkedIn, but as far as going on, a platform like that, have you been able to find that useful at all for finding people?
Here's what you got to do. People just are lazy. All right. Anybody who uses a link, we have a LinkedIn profile that, we sell to people too as well, but it's for commercials, not for you guys. But the problem is anyone who buys a LinkedIn profile, what they want to do is just click a button, and pick up the damn phone, call these people, say, hey, I'd like to talk to you. And really schedule a time of day that's convenient for you and spend no more than 15 minutes, okay? And don't be the one that sends like a Calendarly thing like, hey, I'm so important, link it in, and be like, hey, Jason, I just want to let you know, I found you on LinkedIn. Seems like we have a few things in common. Why don't we just talk? And yeah, I'll tell you what we're doing, and you tell me if you're interested in it. And if you start doing that, and you keep like an Excel spreadsheet of their name, cell phone number, email, what they do, and other things, treat them like friends, not like an ATM machine, because that's what freaks people out. Is that LinkedIn's a powerful tool, but everybody uses it. Nobody scores off of it, right? Nobody really scores off because nobody takes a chance to actually like tell someone to call them and get on the phone. People want that human interaction, especially investors. If you're looking for a $50,000, $100,000 ticket from someone, you better be kind of warm. You better know those people, or you better be prepared. The other thing I like doing is going to grown-up conferences, not necessarily guru conferences, but grown-up conferences. And you can actually just like go to like, a lot of these like commercial real estate conferences, or, some of these, most of the residential or guru conferences, but there are people with money there. But going to other grown-up conferences where you can actually learn where the private lenders are. And I can tell you the higher ticket, the higher barrier to entry it is, usually the better it is. That's it. If you're paying $37 to go to a family office conference, you got played. There's no patriarch is going to meet you for $37 and be French fried with a bunch of other people. It just doesn't work that way. But you can find other investors at those conferences, but just build the relationship. I mean, I say this all the time, and I know this is a family show, but everybody's trying to get laid on the first date, and it never happens. And if it does happen, is that really the kind of investor you want to work with? Who's going to say yes over email? Chances are they're probably from Nigeria, Kenya, who knows? I mean, I've seen it all. But if you just make the time and just dedicate 1 hour a day, I don't care if you have to hide in your office, hide in your car, and you just call 3 or 4 investors and you get to know them, and you just spend that hour of power. In 1 week, I can tell you'll have more confidence, more self-esteem in this business than probably 92% of the participants out there right now.
Yeah,
I guarantee. Agree. I don't guarantee anything.
No, I agree. That's huge advice. Most people nowadays is just all email, and they don't want to pick up the phone and actually talk to somebody, which is huge.
It's a private placement memorandum that's 200 pages, single spaced, size 9 font. Who has time to read that stuff? I mean, I do because we're doing the deals, but like no rational investor has time to sit there and print that out.
Right.
That's when you get to the point. It's like, okay, we're ready to get married. Here's the prenup. That's when you start sending them the information. But you have no right owning a whole doc set that you pay $20,000, $30,000 for just to talk to an investor. Jason, I'm going to send you an email later about a deal we're working on. Okay. Do I need to have all the docs in place? I'm sending you an email as a friend.
No.
Okay. All right. See? So, I mean, is Jason going to call the SEC on me? Probably. No, I'm kidding. But even if he did, that's such a politically driven, understaffed place. I'm not saying, I should be careful what I say here, is that those people who work there are looking to build a name for themselves, and they're going to go after the bigger fish. They're not going to go after the small guys, like the people who are listening here, like, oh, we had one guy, oh, he sent something out to someone. No. And not only that, but the Jobs Act has sort of, 2013 has sort of changed that around a lot,
right? Where
it's become much easier now to solicit investors.
No, I hear you. So, well, let me ask you this. Let's change gears just for a quick second here. Yes. What do you feel with how the market is as of right now, as we're doing this show? Do you feel like the market is poised for a correction, or do you think it's, going to be stable for a while?
What market are you talking about?
Let's get your view on residential and then commercial. So we'll do a 2-parter.
I think residential, and this is me, I'm selling my parents' country house in Eastern Long Island because I think it's the top of the market right now.
Yeah.
So I am a net seller. I think that interest rates going up has pulled a lot of the purchase power out of people. When you have zero interest rates, you can charge, $500,000 for a house that used to be $350,000. So mortgage rates are still low by historical standards, and we haven't seen this much growth in our economy, arguably since 1971. But I'm a financial geek, and I have reasons, I can go off on that, but nothing that your listeners want to talk about. As far as commercial, I think commercial, those who bought well, they're fine. I think they need to pencil in a few more rate hikes. And I think the people who bought smaller commercial, more retail investors, mom and pops, who didn't know what they were doing, they overpaid, they bought on emotion, they didn't buy dispassionately, and they're the ones who are going to be screwed. You can't buy a self-storage facility in El Paso, Texas for a 5 cap thinking you're going to sell it for a 4 cap in a raising right environment. So that's where a lot of the opportunities are going to be. And a year from now, when we have this podcast again, you're going to see that your cousin Sal was right.
Cousin Sal from Wharton. No, no, I hear you. No,
it's true. And people are going to make, and what you're going to hear, and I see it now, is that a lot of the brokers and sellers are saying, well, there's so much capital coming in from China and Russia. That's not true. Russia has long gone away, and New York was a proxy for that. China, I don't know why everybody wants to go with this EB5 stuff. It's all but dead right now. Nobody's doing anything. China, you can't get money out of the country. They have capital controls. So you can't get money out, out of China. So that's not existing anymore. So now that's all left. All that's left is the finance-based economy of the United States, where if you have low rates, you got it. But the problem is, if your cost of borrowing is 4, you're not going to buy a multifamily at a 4 cap, especially a C class. And that's what a lot of people did. Not only that, but you're starting to see, just in residential, a lot of people who bought these assets using interest rate only mortgages are now going to have, in commercial, the ammo kick in, and that's going to cause a lot of problems and heartache going forward.
No, I hear you. Well, no, I appreciate you sharing that. And I know you've got a great website. How can people get a hold of you, Sal?
I think the first thing they need to do is to worry about the website later and download a pitch book. And I would do that now. And they can do that by going to thecommercialpitchbook.com. And it's a free done-for-you pitch book. It's a PowerPoint presentation.
Nice.
It's got great graphics. It's beautiful. It's dialed in nice. It's helped raise already $200 million from our students. So, and that number keeps climbing. We're actually going to start a new initiative next year called the $2 million initiative or something like that, where we're going to challenge people with the pitch book to raise millions of dollars using it, because the power and confidence in your business is directly correlated to the investors and the relationships that you have. And I'm out to prove that it's not just looking for a deal first and then the investors later. You find the investors first, and then the deals will come to you very fluidly.
Nice. So it's the commercialpitchbook.com.
Yes, that's it. You go there, and it's a done-for-you PPT, PowerPoint presentation. And I would say before you eat your next meal or watch your next football game, if you guys do that stuff, I would start filling it in, even on the couch while your wife or spouse is watching TV. What I would do is I would start doing that, and then I would also start putting it on LinkedIn and seeing what kind of notoriety you get. I bet you'll get a few people who are going to ping you back, but that's how you start the conversation. Just don't be all weird and everything like a creeper on social media on Tinder. Actually pick up the phone and call the guy. Especially if it's a woman, call her. I mean, there's enough creeps out there today. People want a real human being who's sane and cognizant and knows what they're talking about.
No, love it. So thecommercialpitchbook.com. Make sure you go grab the pitch book and you'll be able to get some great wisdom from your cousin Sal over there.
Use your words, Jason.
I know, right?
Commercialpitchbook.com.
I can't talk right now, Sal. I get so flabbergasted around you.
Oh, stop.
There it is, the Wharton Cup.
It is. That's it. Yes, I mean, that's what they want to do. And honestly, that's, I think, the most single powerful tool you can have right now in anything you're doing. I don't care if you're doing residential. I'm not going to judge you. I don't like it, but you can use it to raise for your, fix and flips for your residential stuff. It just tells your investors all sorts of questions that they don't ask, but they never will ask you because they don't want to look stupid. But it makes you look like a rock star because it proves that you're seasoned and you know what you're doing, even if you're not that experienced.
No, I love it.
And you can raise money around it too.
No,
Isn't that great?
This has been a great episode, Sal. Any parting words for our listeners that are with us right now on either Facebook or they're listening to it on iTunes? Any parting words that you have for them, or Sal's wisdom of strength?
The money always has a voice, and start talking to the money now, because this cycle is going to happen. It's going to happen fast. And the next cycle is not going to start for another 10 to 12 years. And that's a lot of regret. And regret is probably the most expensive thing you can ever face. Start sharpening your axe, your intellectual axe right now, so that you can take advantage of the downfall that's happening, because that's where real wealth is going to be created. Donald Trump went through this. Sam Zell went through this. My ex-boss, who's the Treasury Secretary today, did this with IndyMac. So there's a lot of things. There's a lot of opportunities. And you just got to start thinking about, okay, what am I doing today that's going to prepare me for the future as it relates to this business? And it's not by reading books. It's going to be by talking to people and actually getting in there and talking to investors and getting confident with talking to investors.
No, I agree. No, that's awesome. That is it for this episode. I would like to thank Sal for joining us today. Make sure you head on over to the commercialpitchbook.com. Make sure you grab that right now. Do it before your next meal, like Sal said, and don't watch TV until you get that thing filled out. Make sure you do that right now. Go and grab that from our good friend, Cousin Sal, my great friend Sal that I've known for quite a while. Go do that. If you have any questions whatsoever, go to support@jasonluchesi.com. And Sal is the only one that I allow to call me Lucchesi. That's the way the New Yorkers say it. So again, support.
I can't even say Nevada right. Okay. So
nice. All right. Well, if you need anything, make it happen. No flipping excuses. And we'll see you on the next episode. Take care. Bye now.
Take care, guys. Take care.